In our episode revision 16, we shall discuss the autonomous and the accommodating transactions under the balance of payments. So this is going to be the last of the revisions in microeconomics. So the balance of payments account, we said it's a statement of accounts, isn't it? So what does it consist of? It consists of the autonomous items and the accommodating items. The autonomous items or the autonomous transactions consist of the current account balance, capital account balance, and the errors and omissions, as we saw in the previous video. The current account balance is again a balance between the balance of trade, that is the export and the import of goods, services in the invisibles, and the transfer payments. Then capital account balance is the balance of accounts on the foreign investments like the FDI, FII, etc., external borrowings and external assistance. Now, whatever was or could not be accommodated into these two will be written under the errors and omissions. Now, each of these accounts will have a credit side and a debit side. This is what we learned. These items are called as above the line items, right? And then finally we have below the line item or transactions, the accommodating transactions. These consist of the official reserves which are managed by the central bank or the RBI. So if there is a deficit or surplus, then that is taken care of by the RBI under the official reserves. So the questions that are asked are, what are the above the line items? The autonomous transactions or autonomous items are the above the line items. Sometimes it is also asked as balance of trade, exports and imports. So where do you include them in the balance of payments? So they have to be included under the autonomous transactions. Sometimes even foreign investments are asked. Where will you include these? So these are the capital account balances which will be written in under the autonomous transactions. Or sometimes which of the following is an accommodating transaction? So some of these current account, capital account would be given, and one would be like official reserves, sale of foreign currency in the foreign exchange market by the central bank to finance the balance of payment deficit. So in case such a question is asked, then that will come under the accommodating transaction. Now we said that there is a debit side and a credit side in the balance of payment account also. That means under the various heads like the current account and the capital account. So balance of payment deficit is when the foreign exchange receipts are less than the foreign exchange payments. Now the balance of payment surplus will be when foreign exchange receipts are greater than the foreign exchange payments. These are the autonomous items, isn't it? The accommodating transactions, the official reserves, these they cover the balance of payment deficit or utilize the balance of payment surplus. The official reserves, they finance the deficit which would decrease the official reserves, and they utilize the surplus which will increase the official reserves. This official reserves is more relevant under the fixed exchange rate system. Exchange rate is the rate at which one currency can be converted into another currency, and fixed exchange or fixed rate would mean that the rate which is fixed by the government. This can be understood by this graph over here, which shows the exchange rate on the y-axis and the foreign exchange rate on the x-axis. This is the supply of foreign exchange, and downward is the demand for foreign exchange. The point at which the demand is equal to supply of foreign exchange is called that exchange rate at which the demand is equal to supply. Since we are talking about the fixed exchange rate, this exchange rate is fixed by the government. Now suppose the government wants to encourage exports. So what will it do? It will make the rupee cheaper for the foreigners. That means it will increase this exchange rate, and so it will go up like this. Okay, so this is the exchange rate. Let us say R1 is the exchange rate that is fixed by the government. At, at this R1, we find that the supply over here, let us call it A, will be greater than the demand, which is B. Let us call it B. So at this point here, supply is greater than demand. Okay. So what will happen at this exchange rate? The supply of the dollars exceeds the demand for dollars. Now the RBI intervenes to purchase the dollars for rupees in the foreign exchange market. By doing so, it absorbs the excess supply, which has been marked as AB over here. Okay. Now, by this intervention, through this intervention, it would accumulate more and more foreign exchange as long as this intervention continues. Now, on the other hand, if the government sets an exchange rate at a lower level, let us say R2, somewhere over here, at this point, we find the demand is greater than supply. Here, demand is greater than supply. Okay. So, what happens over here is there is excess demand for dollars in the foreign exchange market. So, to meet this excess demand, the government will have to withdraw the dollars from the past holdings. This needs to be done because if it is not done, then there will be a black market for dollars. So, that's how the fixed rate is taken care of. So, from this we understand the official reserves can be increased by increasing the rate of exchange. So, this would bring in more supply of the foreign exchange and the official reserves would increase. This increase in rate, which makes the domestic currency cheaper in terms of a foreign currency, is called devaluation. It is called as devaluation. Sometimes it is asked what is devaluation of domestic currency. Then we need to write, we need to draw this graph. If it is a 3-mark question, then write it's called devaluation because the rupee exchange rate increases and so it becomes cheaper in terms of the foreign currency. Then if you bring down to R2, this is called as revaluation or appreciation of the domestic currency. So here what happens is the domestic currency becomes costlier in terms of the foreign currency. In that case, imports would increase and the foreign exchange there will be an outflow of foreign exchange. Now let's revise floating exchange rates. Floating, as the name tells, that's not a fixed rate, it keeps on changing. And these exchange rates are due to the forces of or determined by the forces of the demand and supply of the foreign currency or foreign exchange rate. Here there is no intervention of the central bank. Therefore, there are no official reserve transactions. Since there is no intervention of the RBI, there are no official reserve transactions. Now, what are the sources of demand? Demand means that which would cause an outflow of foreign exchange. So, the sources of demand for foreign exchange are imports of goods and services, foreign exchange transfer payments, foreign transfer payments if you want to gift somebody who is living outside India, then investments made abroad, foreign travel, if you want to visit some place during your vacation, a foreign trip, then you will need the foreign currency. Then sources of supply. This causes inflow of foreign exchange. So here the opposite of this happens. Here exports of goods and services takes place. There will be foreign investments, there will be foreign companies investing in our country. Then factor incomes would flow in. That means factor income from abroad. So there is an inflow of the foreign currency. Then foreign tourism. If more foreigners visit our country, then there will be an inflow of foreign exchange. Remittances from abroad. If you get gifts from outside, from relatives living outside in foreign countries, then there would be an inflow of foreign exchange. So the questions asked over here are, what do you understand by floating exchange rates? And what are the sources of the demand of foreign exchange and what are the sources of supply of foreign exchange? So here we should be able to write that there will be an outflow when there is demand and there will be inflow when there is supply. Then the last of it is managed floating rate. So the name itself tells us the floating rate is managed. Here it's a combination of both the floating exchange rate as well as the fixed exchange rate. The forces of the demand and supply determine the foreign exchange rate, which is the floating part of it, and the RBI intervention to control the fluctuations in the foreign exchange rate would be that of the floating exchange rates, fixed exchange rates. So here the exchange rate would be within a specific range, right? So this managed floating is otherwise called as the dirty floating exchange rate, because the exchange rate is influenced by the intervention of the central bank in the foreign exchange market. In one of the CBSE sample papers 2015, this question was asked: what is the role of central bank in the following exchange rates: the fixed exchange, floating exchange, and the managed floating? So this is what we need to write: the role of central bank in the exchange rates. Okay. Then in 2018, it was asked: devaluation and depreciation of currency, are they one and the same thing? So devaluation and depreciation imply a fall in the external value of the currency. The depreciation is, bringing down the foreign exchange rate. So it is determined by the market forces of demand and supply, right? Then devaluation is the exchange value of the currency decided by the government. That is, a deliberate value of the currency is decided. Then depreciation and devaluation normally encourage exports from a country, as exports become cheaper for the foreigners, and the foreign currency can buy more of domestic goods, and that means there will be more inflow of the foreign currency. Then sample paper 2020, there was one question on Make in India. So Make in India plan that has been introduced by the government would ensure inflow of foreign exchange, leading to increase in the supply of the foreign currency, right? Finally, a word of this that the exchange rate in a free market has been deleted from the portion, so that we will not be revising.